Names have done really well in 2020 off the back of better earnings, certainly relative to value. The drop in interest rates we saw this year lifted growth PEs pretty extremely, and that's why you've seen a record outperformance, as you showed, about 38 or 40% versus value. Looking ahead to 2021, we're going to see earnings pick up. We're going to likely see bond yields grind higher. And so that's a backdrop where cyclicals and value stocks look much more attractive to investors. And growth stocks, a lot of these high flyers this year, probably going to be underperformers in 2021.
To that point, though, Michael, a lot of the tech names, especially the software names, are certainly expensive. I think a lot of people would agree to that. But they have disrupted the way a lot of us live, the software names, especially the way a lot of us work. Is the premium warranted? And by the way, they've disrupted a lot of the value names. So talk to us a little bit about that.
Yeah, there's a huge spread between value and growth, and that's been growing over the last 5 years. And that is due to disruption. It's also due to lower rates keeping a lot of zombie value companies alive. So investors are indeed paying up for growth names where they can find it. We did some analysis early this year and found that there's only 66 names in the S&P 500. They're actually growing their revenues double digits on average over 5 years. That compares to about 250 names doing the same back in 2000. So growth has certainly become scarce, and that's why it's done so well in the past few years. But earnings should rebound, as we've talked about, in 2021 into 2022. And so for investors, that premium is no longer warranted as much.
Let's talk about some of the sectors you do like. So you say you favor consumer discretionary and industrials over financials and energy. It's interesting. Citi just came out with a note yesterday saying that energy was its top contrarian pick for next year. Tell us a little bit about why you favor those two sectors.
Sure. For industrials and consumer discretionary stocks, we think they're going to continue to benefit from the reopening and recovery in the global economy. We expect interest rates, though we expect them to move slightly higher, they're going to remain historically low. That means debt service payments for consumers, whether it's mortgage or credit cards, are going to remain extremely low. We don't expect a major move in oil to cause any demand destruction for the consumer, and jobs are coming back. So for consumer cyclicals, we think that's kind of a sweet spot. It's not the housing trade that was great this year. That's probably behind us, but it's really about consumer durables and a pickup in consumption next year. And then for industrials, every signal we have that has any ability to forecast industrial activity like PMIs is telling us that industrial activity is going to remain very healthy in 2021. And that's a really bullish sign for the industrial sector. And for financials and energy, it's obviously a good thing that we're seeing growth recover, but financials, for example, not only need a recovery, they also need higher interest rates. And while we think rates will go up, we think they're going to go up really slowly. So I'd rather own companies and cyclicals that can benefit without the requirement of higher yields.
Shepard Smith here. Thanks for watching CNBC on YouTube.